Okay, hi everyone, welcome to today's webinar. So for today's session, we are going to be talking about sentiment analysis in trading. We'll give about 2 more minutes to let more people join our session before we get started. In the meantime, just let me know in the chat if you guys can see me and hear me. And yeah, I'll see you guys in about another 2 more minutes. Thanks, everyone. Okay, let's go ahead and get started. So once again, welcome to today's webinar. For today's session, we are going to be talking about sentiment analysis in trading. As per usual, a disclaimer and risk warning. The information is not considered as investment advice or recommendation, but instead a marketing communication. And the risk warning, our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, so you should ensure that you understand the risks involved. I'm Melanie, and I'll be your speaker for today. I'm an investment analyst at Rocket, who are finalists for Best FX and Equity Research in the years 2019 to 2021. Okay, so here's today's agenda. We're going to start off by talking a bit about what exactly is sentiment analysis. Then we'll go through a couple of tools and techniques for measuring market sentiment, how to integrate sentiment analysis into your trading strategies, and then we'll look at some examples and case studies. If we have time at the end, which I think we should have, we'll also look at some charts. So during that time, you guys can just pop into the chat any requests for charts you'd like me to go through. Okay, without further ado, let's go ahead and get started. So what exactly is sentiment analysis, right? So firstly, sentiment analysis in trading is basically the process of gauging the collective mood of the market participants. So it helps us to answer questions like are traders feeling optimistic or pessimistic? Is fear or greed dominating the market? And this is important because it often drives price movements, sometimes more so than fundamentals or techniques. I mean technicals, sorry. Okay, so to go through a bit of basics to start off, let's take a look at what exactly is a bullish and bearish sentiment. So I'm sure we're all pretty familiar with this, so I'll go through this quite quickly. Basically, a bullish sentiment is characterized by optimism. Traders and investors believe prices will rise. So you'll often hear phrases like the bulls are in control or things like buying momentum. So in practical terms, a bullish sentiment might result in increased buying activity, obviously in the market, also rising prices, especially in risk on assets like stocks or growth currencies like Aussie dollar or Kiwi dollar. So an example we can talk a bit about is in 2020 when institutional players like Tesla and also MicroStrategy began investing in Bitcoin, then the market sentiment turned bullish, pushing Bitcoin's price to new highs. Next, if we look at bearish sentiment, so bearish sentiment a bearish market is basically dominated by fear or pessimism. So traders and investors will expect prices to fall. So in this case, terms like the bears have taken over or selling pressure are quite common. And bearish sentiment will often lead to increased selling or short selling activity, declines in risk assets, and a flight to safe havens like your gold, USD, or JPY. So, for example, during the COVID-19 pandemic, we saw global markets having a sharp drop due to bearish sentiment as panic selling gripped investors um, due to fear of economic downturns. Okay, now let's talk a bit about how you can measure sentiment effectively. So there are several tools and indicators to help you. Firstly, we have the sentiment indicators. The Fear and Greed Index shows market emotion at a glance. Commitment of Traders Report or the COT reports give us insight into institutional positions. And then we have the FLIX or Volatility Index, often called the fear gauge, and we'll talk a little bit more about that in the next couple of slides. Um, Next, we have social media news analysis. So tools like sentiment scanning software can analyze headlines, tweets, social media sentiment for actionable insights. And you can also there's a lot of discussion on, for example, on Twitter, of sentiment-driven market moves. So, for example, like Elon Musk tweets. We'll also elaborate a bit more on sentiment scanning software, what you can take a look at. In a couple of slides, I think. Okay, and lastly, there are currency-specific sentiment tools as well. So brokers' client sentiment indicators show the percentage of traders who are going long or short on a pair. Forums and platforms like TradingView, Moomoo as well, or even sentiment heat maps can provide you with currency-specific sentiment. Okay, so let's talk a bit about the VIX index that we mentioned earlier. So the VIX index was created by the Chicago Board Options Exchange, or the CBOE, and it measures the expected volatility in the S&P 500 over the next 30 days. So as you mentioned earlier, it's also known as the fear gauge, and it's calculated based on the prices of options on the S&P 500 index. So it gives us a sense of market expectations for short-term volatility. In simpler terms, when VIX values are high, it suggests that investors are expecting turbulent times, whereas a lower VIX indicates that markets are calm. The VIX is unique in that it captures implied volatility, which is based on how much market participants think the S&P 500 might fluctuate, rather than just looking at historical volatility. So the VIX is highly sensitive to shifts in market sentiment, and here's how it works as a barometer for fear. So a high VIX, as we mentioned earlier, is above 20 to 25, and this level suggests that there's increased market fear or uncertainty. And investors may be concerned about events such as economic instability, geopolitical events, or tensions, or upcoming announcements from the Federal Reserve. So very high VIX, such as 40 or 50, often signals market panic, as seen in major crises like the 2008 financial crisis or the COVID-19 pandemic. A low VIX, which is below 15, signals a calm market where investors are generally confident about stability, um, while it might indicate complacency, it also reflects lower expected price swings, meaning that investors are less fearful of sudden market shifts. So understanding these ranges can help you to gauge market sentiment and make decisions about your risk management strategies as well. Okay. So now let's talk about how to use the VIX as a predictive tool. Firstly, you can use it to identify corrections. So a sharp increase in the VIX often accompanies corrections or bear markets as fear drives investors to buy protective options. Excuse me. Next, we have but just take note that spikes in the VIX can often serve as warning signs of potential downturns. Um, so it can allow you as a trader to anticipate and prepare for corrections as well. Okay, next is spotting market bottoms. So during a market sell-off, the VIX may reach extreme highs. This can signal capitulation, which is when investors sell en masse out of fear. So very high VIX can sometimes signal the peak of market fear, after which a reversal might occur. And lastly, anticipating rallies. So after prolonged periods of high VIX values, market stability can improve, potentially leading to a rally. So a declining VIX can during a downturn can indicate that fear is easing and markets are poised for recovery. Okay, let's look at some VIX-based trading strategies now. So firstly, we have the VIX options and futures. Traders can buy VIX options or futures contracts to gain exposure to volatility. So an example of this can be if you're expecting a market drop, for example. You might buy VIX call options, which gain value when the VIX rises. And then if we're looking at ETFs and ETNs, so ETFs are your exchange traded funds and notes. So those that are tied to VIX offer exposure to volatility without directly trading futures. So examples include the VXX, which is the short-term VIX, VIX ETN, and the UVXY. Um, yeah, which is a leveraged VIX ETF. Okay, and number three, you can look at hedging with the VIX. So if you have a portfolio of stocks, a rise in the VIX often correlates with declining stock prices. So by adding VIX exposure through ETFs or options, you can offset some of the potential losses in your equity positions during volatile periods. Okay, number four, mean reversion trades. So the VIX is known to revert to its long-term average over some time. So after extreme spikes, some traders use mean reversion strategies, anticipating that the VIX will return to normal levels once fear subsides. Okay, so just to circle back to point number two, these instruments, so your ETFs and your ETNs, these are normally used for shorter term hedging or for speculative purposes. Okay, now let's take a look at a couple of examples of real life market reactions to VIX spikes. First, we have the 2008 financial crisis. So during this time, the VIX surged above 80 during the height of the crisis, reflecting extreme fear. The spike coincided with one of the steepest drops in the S&P 500. As the VIX eventually declined, it signaled a calming of market fears, allowing for recovery. And secondly, we have the COVID-19 pandemic. So again, the VIX reached levels above 80 as the pandemic began, signaling intense fear and uncertainty. The market saw a swift downturn, but as the VIX fell in the following months, it corresponded with a market rebound. Some other events include elections, major Fed policy announcements, and geopolitical events like Brexit or trade wars, which also led to notable VIX increases. Each spike served as a signal that the market expected increased risk, often preceding market volatility. Okay, let's maybe take a look at our charts now. So this is our VIX chart. So I've highlighted some points where the VIX really spiked, and you can see the first spike. Okay, let's see how far back we want to go. So I guess in 2008, global financial crisis, you can see, um, yeah, over here, 2008, the VIX really spiked up to one of the highest levels over here. Okay, and we mentioned earlier the COVID-19 pandemic over here, March 2020. You can also see the VIX spiking upwards as well here. The most recent spike that I identified was actually um August of 2024. I'm not actually sure what that event was. Do you guys have any idea what it could be? Oh, wait, we have a question in the chat. Let me just check that. Um, is the VIX index uh is it leading or lagging? Okay, so the VIX is actually a leading indicator. So because it's considered a market sentiment, so that's why it's a leading indicator for market sentiment. But it also kind of has characteristics of a lagging indicator in certain specifics. So if we think about it as a leading indicator, firstly, because it's derived from the S&P 500 options prices, right? So that reflects the traders' expectations of volatility over the next 30 days. So that anticipates market sentiment. And it often rises before significant market downturns as well, since investors are using it as a hedge against potential risk. So yeah, so in that sense, it's a leading indicator. Um, but it could also, I guess, be used as a lagging indicator because it's a response to recent volatility as well. So so for example, if the S&P 500 if experiences a sharp sell-off, the VIX rises after the event as option premiums will increase, right? So it doesn't necessarily predict the cause of the volatility, but it reflects traders' reactions to recent movements, if that makes sense. So I guess it's both. You can monitor the VIX for spikes that might signal a reversal in equity markets. Um, that would be how you can use it as a leading indicator, but just as an example. In a lagging situation, you can just use it to gauge the current sentiment and also validate the strength of the market trend. So, for example, a declining VIX will often support bullish momentum. So, in that sense, it would be a lagging indicator. But primarily, I would say it's a leading indicator since it reflects market participants' future expectations of volatility. Okay, yeah, I hope that makes sense. But again, when it comes to VIX, like all in other indicators as well, it's most effective when you're combining it with other indicators, so that it confirms or anticipates market sentiment shifts as well. Okay, I hope that answers your question, but feel free to let me know if you have any other questions. Okay, I guess we can get back to our slides. Okay. Yeah, we already went through this. So next, let's talk a bit about the key considerations when trading the VIX. So there are a couple of factors to keep in mind. Firstly is the VIX decay and mean reversion. So VIX-based instruments like ETFs can experience decay due to their reliance on futures contracts, which roll over each month. So this means they're often better suited for short-term trades rather than long-term investments. Number two, event-driven spikes. So we talked about this a little bit, but specific events like elections, Fed announcements can cause temporary VIX spikes, which often return to normal once the event passes. Alternative volatility indicators. So while the VIX is powerful, some traders also consider other indicators like the VVIX, which is a volatility of VIX, um, and or the MOVE index, which is volatility in the bond market, to get a broader view of market sentiment. Okay, so let's talk about the second method that we kind of briefly mentioned earlier, which is social media platforms and news outlets. So these are often valuable sources of sentiment data, especially in today's trading world. So some examples, I guess, are real-time alerts. So tools like Hootsuite Insights track keywords or hashtags, like hashtag Bitcoin crash or stock market, and sentiment-based alerts help traders act quickly on market-moving information. Next is also cross-referencing data, so you can compare social sentiment with technical indicators like RSI or MACD to confirm your trade setups, and then use social sentiment as a contrarian indicator when it reaches extreme levels. Okay, and lastly, predictive insights. So, sentiment trends can sometimes precede actual market moves, offering predictive power. We kind of talked about this already, especially with VIX kind of being a leading indicator as well. Okay, so now that okay, let's maybe talk a little bit about some examples of social media being um, I mean, market sentiment on social media contributing to panic selling or euphoric buying, for example. Okay, so I think the biggest one would probably be Elon Musk's tweets about Bitcoin and Dogecoin, which have caused significant market movements. So I think in May of 2021, he tweeted announcing that Tesla would no longer accept Bitcoin due to environmental concerns, and that led to a really sharp drop in Bitcoin's price. Um, and then his positive tweets about Dogecoin have repeatedly driven spikes in its price as well. Yeah, and there are a bunch of sentiment analysis tools as well, like TweetDeck, Sentiment, Sentiment Trader, and other. You can also use other APIs if you know how to kind of code that into Python. It can help you to track the overall mood around specific assets. Uh, yeah, off the top of my head, that's mostly all I can think of if we're talking about social media. If we're talking a bit about news headlines, obviously positive headlines like if the Federal Reserve announces interest rate cuts that can spark bullish sentiment in stock indices. Whereas on the other hand, negative news like unexpected inflation surges, for example, that can cause bearish turn in bond and forex markets. So again, sentiment analysis software like um, Bloomberg Terminal, I think, and also Thomson Reuters, I think. I think both of those, yeah. I think they use natural language processing to kind of rate its news headlines as positive, negative, or neutral. So if you're familiar with that software, you can use this analysis to anticipate market reactions as well before prices fully adjust. Okay, so now that we've kind of discussed what sentiment analysis is and what tools are available that you can use, let's talk about how exactly you can use it in your trading. So firstly is contrarian strategies. So when sentiment is overwhelmingly bullish, you can consider a bearish position and vice versa. Extreme sentiment often signals a market reversal. And then number two, combining sentiment with technical analysis. So we briefly mentioned this earlier about using sentiment as a filter alongside your technical indicators like RSI, Bollinger Bands, or your moving averages. So for example, if sentiment is overly bearish and RSI shows oversold conditions, it may signal a buying opportunity. And lastly, sentiment in trend following strategies. So positive sentiment can confirm an uptrend, while negative sentiment can validate a downtrend. So a risk management tip here is to just always remember to use sentiment as a supporting tool rather than the sole basis for your trading decisions. So yeah, so you can pair it with a good um, risk management practice or strategy uh, alongside all of the technical analysis that you will do as well. Okay, any questions so far? Okay, that brings us to the end of my slides, or we still have time. So let's go ahead and take a look at some charts. If you guys have any requests on any charts, feel free to let me know in the chat. While I pull up my charts. Mm, Okay, we'll start off by looking at DXY. And then we can look at gold and we can do any charts that you guys might have. It's taking a while to load. Just give me a second. Not sure why my Wi-Fi is so slow today. Okay. Mm, Or just give me a second. I don't know what's going on. Okay, great. Can you guys see my charts? Oh wait, okay, we have some questions in the chat. Let me just open the questions. Okay, first question. Okay, if we look at the VIX index again, earlier I mentioned, yeah, so earlier I did mention this spike, this reset spike here. And I said I wasn't too sure about what the actual reason for the spike was on kind of on 5th on August. I think it was August 5th. Um I'm not too sure. I think the reason could actually be because fundamentally the Japanese yen, um I could be remembering wrongly, so I just wanna check real quick. But um I think because the events of the previous week, namely the Bank of Japan raised its interest rates unexpectedly. So I think that could be a contributing factor. Don't quote me on that. I just, if I remember correctly, I think that's a reason. Um, of course, also due to S&P 500 put and call options, since that's how the VIX is calculated. And so in general, like the positioning of the ETFs that also contributed to it. But if we're talking about fundamentally, I think it's because of the previous week's events, which the biggest event that week was probably the Bank of Japan raising its interest rates unexpectedly. But again, don't quote me on that. You can Google it yourself. I'm pretty sure this was August 5th. Um, yeah, yeah, 5th August. Okay. Um, okay, we have another question. Does the risk off and risk on Baby Pip's website is it a reliable market sentiment for trading? Um, Let me just Google this real quick. Okay, so I'm trying to open the Baby Pips website, um, but it's not loading. Okay, but while that loads, um, I think it can be helpful to give you some insights into market sentiment, but it shouldn't be the sole basis for your trading decisions. So, some strengths of it is that the risk on risk off framework, it does help you to quickly understand whether the market is favoring risky assets, which would be risk on, or safe havens, which is risk off, right? So for example, I guess some examples of risk on assets would be like your stocks, or like high yield currencies like Aussie dollar, Kiwi, emerging markets as well. And risk off would just be your safe haven assets like USD, JPY, Swiss franc, bonds. So baby pips, the way that they approach things is typically in a very beginner friendly manner. So it helps newer traders to kind of grasp sentiment shifts and the impact on various asset classes as well. So in that sense, it can be helpful. Um, I think some limitations with it, uh, let me think. I think some limitations firstly is that it's quite it's a lagging it's of lagging nature. So the sentiment that's displayed may lag with real-time market shifts, especially during really volatile conditions when your sentiment can flip rapidly. There's also kind of a lack of nuance, I think. So it offers a pretty generalized view of the sentiment, so it might not be able to capture specific drivers affecting individual currencies or asset classes. Yeah. Um, yeah, and it also doesn't, I mean, it shows you the prevailing sentiment at the time, but it doesn't really provide actionable insights for entry or exit points. Yeah, that's all I can think of off the top of my head. Uh, Let me see if my Baby Pip's website has loaded yet. Okay, yeah, it's loaded. Let me just share that with everyone since we're talking about it now. Okay, so this is what he was talking about, or I was talking about from the question, about risk on and risk off. And this is from Baby Pip's website. Yeah, so like I mentioned, it kind of gives you kind of a more generalized view. It does tell you, I mean, you can look at it at one glance and you can see exactly what the general sentiment is. Um, yeah, and what the risk on, risk off indicators are showing us. Yeah, and there's also explanations below. So it's like I said, it's very easy to understand, really good for beginner traders as well. But yeah, some of the limitations are just those that I mentioned earlier. But I think if you want to use this in combination with the indicators that we mentioned earlier, that's great. But probably don't rely on this on its own. Yeah. Okay. Thanks for the questions, everyone. Um, yeah. Let's go ahead and I think we have time to maybe look at one chart now. So we'll look at DXY. So on our weekly time frame, you can see our DXY kind of reversing a little bit recently, and you can kind of see that on our daily time frame as well. Now on our 4 hour time frame, okay, I'll just place my first resistance up here, first support. Okay, and I want to place an intermediate support level here as well because it's in line with two swing highs, and that's actually where price is currently at now. So I just want to be extra careful in that area. Um, yeah, I'll place my second support here. So we are expecting prices to continue moving downwards, because since we are generally following the overall trend. So here you can see prices breaking out of this intermediate support. Um, and I'm expecting it to continue towards my second support. Okay, so going in with some indicators now, I'm going in with a retracement to start off. My 38 lines up, and my 38 and 61 both line up. Okay, and my 23 and 38 also line up. Okay, nope. So even though 100% here lines up nicely with our first support, we can't really use it because price has already broken out of that level. Okay, it's already broken out of it here. Mm, oops. So a really good habit is to try and pull back as far as you can, so that you can see how many times price has tested that level. Um, that's kind of how significant it is. Okay, I don't really have any levels that line up. I guess my 50% is quite close to that, so I might just keep that. Quite close to our first resistance. Okay, yeah, I think that's all the levels we have. Now let's look at some indicators. I like to start off with Ichimoku and MACD because at one glance you can tell exactly what the signals are. Okay, so you can see price kind of moving within the cloud. So that's not really telling us anything. We can't really use that now. Kind of suggests a bit of a transition period. So that's KIV that. MACD you can see is giving us a pretty bearish signal. So that does support our analysis. Bollinger Bands, you can see price pushing below that lower band. So that's also a bearish signal. I like to use EMA, SMA, and parabolic style together. Let's hide the Bollinger Bands for a second. And you can see prices moving below all three of these indicators. So that's also supporting our bearish analysis. Now, if you look at stochastic and RSI, mm, okay, over here we have a divergence. Okay, let me change the color of these lines. I think it's a bit hard to see. Okay, so if we look closely, you can see that on my stochastic, price made a lower high, right? Whereas over here, price actually made a higher high. Okay, so this is what we call a bearish divergence, and it's a signal that prices should continue to drop. Okay, so yeah, that also supports our analysis. Okay, so we are expecting prices to continue to drop from that first support down to this second support. Just be careful of this intermediate support over here that I've highlighted because um yeah, price has tested this level many times in the past. So we could see price kind of reacting off that level before heading downwards to our second support. Okay, because there should be enough bearish momentum to push it down. Okay, any questions? Okay, if not, yeah, thank you guys so much for joining me today. I hope you guys found the session helpful. If you guys have any other questions, feel free to just pop them into the chat. But if not, feel free to leave the session. Yeah, have a great rest of your week, and I will see you guys again next week. If you guys like me, feel free to connect with me on LinkedIn. It's just my name, Melanie Chong. And yeah, I'll see you guys again next week. Thanks, everyone. Bye. Thanks, everyone. See you guys next week.